Hello everybody, this is Michael Carroll. Thank you for joining me for Business 201 final exam review. We'll jump right into it. So, we'll first be going over Chapter 10, which is going through bonds in this first problem. So, question 1. We've got Vandelay Industries issues a 2% 10-year $100,000 bond, and interest is recorded semi-annually, and the price is 103. So that's a lot of information for bonds. This 2% is the payment, or the stated rate, or the coupon rate. There's a bunch of different names for it. The company is going to pay 2% of $100,000 every year. But since this is a semi-annual bond, we're actually going to pay 1% of the $100,000 bond every 6 months, or every half year. The bond is 10 years, and we've got 103. Remember that that's a percentage. Accountants and finance people don't like to put the percentage next to it for some reason, but remember that's 103%. So let's record the issuance of the bond. So we're going to receive cash, and we receive cash for the amount, or for the price of the bond. So the price is 103% of the face value. 103% of 100,000 is 103,000. So we'll debit cash, and we're going to credit bonds payable, set up the liability, and for this we only set it up for the face value, the 100,000. Now this difference is going to be we need a credit of 3,000 to balance this out, and this bond is recorded at a premium because the price is larger than the face value. Premiums have a credit balance. So there's our issuance of the bond, journal entry. Next, we'll record the entry on July 1st, 2017, which is half a year later, because we're paying interest every half year. So on July 1st, we're going to record some kind of interest expense as a debit, and some kind of interest payable as a credit. The interest payable is always our stated rate times the face value. So 2% of 100,000 is, I think, 2,000. $2,000. So that means that the bondholders, or the company, is going to pay the bondholders $2,000 every year. But remember, we're recording half a year later, so it's actually going to be half of that, $1,000. So every 6 months, the bondholders get $1,000 from the company. There's our interest payable. The interest expense, though, is not going to be $1,000. It's going to be something different, because we've got a premium on this bond. And when we have a premium or a discount, we have to amortize this. Or in other words, we have to slowly get rid of this $3,000 over the course of the bond's life. And the way we do that is we straight line it. And remember, straight line is just the value of whatever you're amortizing divided by the useful life, or divided by the life. And in this case, it's 10 years. So we get 300. And then an extra step to that, because this is semi-annual, we're going to amortize it by 300 every year, and we'll divide that by 2 to get 150 every half year. So there's our amortization, 150. Now, are we going to debit or credit the premium? Well, since we're amortizing, or in other words, we're getting rid of the premium, we have a credit as the premium up here, So we're going to have to debit the premium as we amortize. So debit 150 to the premium. And then our interest expense is whatever is left over. So 1,000 minus 150 is 850 to balance the equation, or to balance the journal entry out. And there we go. There's our journal entry for July 1st. Now, journalize the entry on December 31st, 2017 when interest is paid. So again, we're going another half year. Every half year, we're going to record this journal entry every time. So on December 31st, 2017, we would have interest expense for $850, amortize the premium for $150, and credit interest payable by $1,000. Every 6 months we make this entry. So every July 1st we'll make this entry, and every December 31st we make this entry. But we're also paying interest on December 31st. So in addition to this journal entry, we're also going to credit cash because we're going to pay cash, and we're going to get rid of our interest payable. Our interest payable so far is $2,000. Now I got that from this interest payable and this interest payable. We owed $1,000 for the first half of the year, and then we owed another $1,000 for the second half of the year. So we'll pay the bondholders a total of $2,000 and get rid of the interest payable for $2,000. There's all our journal entries. Moving on to the next problem, we got a bond that is pretty much the same. The only difference is the price is at 96. And remember, that's 96%. So let's record the issuance of the bond. Whenever we issue a bond, we always get cash. So debit cash. And the amount of cash we get is calculated the same way. 96% times the 100,000, which is $96,000. And again, we set up the bond payable. And just as before, we record it at the face value of $100,000. And then the difference between the two will be the discount or the premium. And in this case, we know it's a discount of $4,000. We need a debit of $4,000 to balance this journal entry out. And it's a discount because the price of the bond is smaller than the face value. There's our issuance of bond. Let's journalize the interest on July 1st. Just like before, we always record interest expense as a debit. And we'll have some kind of interest payable as a credit. Our interest payable, we calculate the same way. We take the stated rate times the face value, so 2% times the face value. And remember, it's for half a year. So that's, again, for $1,000. Our interest expense, though, again, is not going to be $1,000. It's going to be something different because we have a discount. So just like before, we're going to amortize this discount. And the way we amortize, take the value, divide by the life, which is $400, and then divide that by 2 because it's semi-annual to get 200. Oops, sorry. So here's my math for amortizing, or figuring out how much we're going to amortize. Here's my math to figure out the interest payable. So we got $200 for the amortization. Now look to the discount. We originally set the discount as a debit. So to decrease the discount, we're going to credit the discount as we amortize. There we can figure out our interest expense, which is $1,200 to balance the journal entry out. Now we'll go to December 31st when interest is paid. Again, same journal entry as before. Interest expense is $1,200. We'll amortize the discount by $200, and we set up an interest payable for $1,000. And in this case, we're paying the interest on December 31st again. So, just like before, we will debit interest payable by $2,000, credit cash for $2,000, because we have an interest payable for the first half of the year for $1,000 and another $1,000 there. Moving on to page 3, we've got a question asking, when a bond is purchased at a discount, which is higher, the market rate or the stated rate? So let's look back to this problem. It's asking about a discount bond, and we just did a discount bond. We have a stated rate of 2%. So our stated equals 2%. So the question is asking, is the market value higher or lower than that? So the way you think about this is this bond is paying a 2%, or is promising to pay 2% interest. Now, investors or the public, when they look at this bond, they are demanding that they purchase it at a discount, or that they get a good deal on this bond. Now, the reason they would demand a lower price for this bond is because this bond is pretty crappy compared to the market. So in other words, the market may have a interest rate of 4%, but this bond says that it will give 2%. So investors will look at that and say, hey, I can go out on the market and find an even better bond that gives 4%. Why would I buy this 2% bond? And so they demand a discount on the bond because they're not getting a good interest rate. So when a bond is purchased at a discount, which is higher, the market rate is higher. Now we can reverse that. We can ask, when the bond is purchased at a premium, which is higher? Well, if our stated rate is 2% and our market is at 1%, people would say, hey, this bond here is a lot better than what's out on the market. And then through economics, since that bond will be in high demand because it's got such a high interest rate, it will increase the price of the bond, which will create a premium. So when a bond is purchased at a premium, the stated rate is higher. Okay, so assume this company has the following effective interest, whatever. We've got an amortization table here. Perform the cash interest payment journal entry for period 4. So amortization tables give you exactly what you will journalize. So these 3 columns right here, cash, interest, and amortization, the first 3 columns give you your interest journal entry. So whenever we record an interest journal entry, we have interest expense, interest payable. Our interest payable is going to be the amount of cash that we owe them, which in period 4 is $50. Our interest expense is given here, $58.45. And then our amortization is $8.45. Now, is this going to be a discount or a premium? And we can look here. It's talking about a discount. So whenever we amortize a discount, we credit the discount for $8.45. And our journal entry balances. This journal entry, you should be familiar with it or recognize it. It's the same journal entry that we recorded in the previous two problems here. So, since we're talking about an amortization table here, why don't we create an amortization table for the previous two problems? So, looking at the first problem, we've got a premium bond. We'll have a cash, period, interest, amortization. We're talking about a premium. And then our bond. So here we go. So in our first problem, we've got a $100,000 bond, a 10-year bond, $100,000 with a stated rate of 2% and a price of $103. So our price is $103. That's what we calculated. So there's our bond carrying value on 1/1/17. And our premium is $3,000. And I got those numbers exactly from our journal entry here. So there's the issuance of the bond. Now, 6 months later, we recorded interest expense of $850, a premium of $150, and interest payable of $1,000. So our interest payable of $1,000 is our cash payment. $1,000. We figured out our amortization was, let's see, $150, and our interest expense was $850. Our new premium carrying value, it started at $3,000, and we're going to subtract $150 from that. And that gives us $2,850. Our new bond carrying value is $102,850. There we go. Now, the reason I knew to subtract the $150 from the $3,000 is because our premium, as we go along, our ending value, we want to end at 0. So if we start at $3,000, want to end at 0, we're going to constantly subtract the amortization. Same thing with the bond carrying value. We want to end at $100,000. So we began at 103. We want to end at 100. So I'm going to subtract the amortization from the bond. So there's for period 2. And then 12/31/17. It's the same numbers every time. So $1,000 for the payment, interest is still that, amortization is still that. Our premium now is $2,700, and our bond carrying value is $102,700. And you can keep going and going for 10 years, and you will end at 0 and 100,000. Now let's try it for the discount. So on 1/1/17, if we go back to our original problem, the price was $96,000 and we had a discount of $4,000. So there's our bonds carrying value and a discount of $4,000. 6 months later, we have a payment, and if you look back at your journal entry, we have $1,000 interest payable. Our interest expense is $1,200, and our amortization of the discount was $200. Now again, the same logic. We're starting at $4,000. We want to end that discount at 0. So I'm going to subtract the 200 from the 4,000, and that gives me 3,800. And then use the same logic for the bond carrying value. We start at 96,000. We want to end at 100,000. So instead of subtracting, I'm going to add the amortization. And then 12/31/17. Again, same numbers from the journal entry. Our discount is now 3,600, and our bond carrying value is 96,400. And that will continue on until the discount is 0 and the bond is 100,000. There's our amortization tables. We'll move on to the next question, which is redeeming a bond early. Let's see. So we've got a company that redeems a $1,000 bond at 101 when its carrying value is 870. What's the journal entry? So this is calling a bond. In other words, we're not waiting for the 10 years or we're not waiting for maturity. When it's officially done, we're calling it early. So we're redeeming a $1,000 bond. We're going to get rid of the bond payable by debiting bond payable for the face value, which is 1,000. We're going to pay cash for 101 of the face value. So 101% of 1,000 is 1010. We also got to get rid of the discount. So the bond's carrying value right now is 870, and the face value is 1,000. So the discount is that difference, 1,000 minus 870, which is 130. Now to get rid of the discount, discounts have a natural debit, so we will credit the remaining discount. And then whatever that difference is our loss on redemption of 140 to balance the journal entry out. Okay, moving on from bonds, we're going to journalize some employee wages. We've got a company that owes employees $50,000 in salaries. From the following information, prepare the journal entries. So we will always record a wages expense and some kind of wages payable. Our wage expense is always however much we owe our employees. So the $50,000. But, and I'm sure as you guys know, whenever you get a paycheck, the company takes out money to pay for taxes, to pay for FICA, to pay for, all this other stuff. So if we're being paid $50,000, but we're going to take $38.25 out of FICA. 38.25. We've got state unemployment tax. Oh, actually, nope. That's not for the employee. Federal income tax payable. So income tax payable on the federal level, $3,000. We've got state income taxes. $5,000. And then the rest goes to wages payable. We skip the unemployment taxes because this is for the employee. This is the journal entry recording how much money is going to the employee. Wages payable then is whatever that balance is out to. 50,000 minus 3825 minus 3 minus 5, 38,175. So even though you earn $50,000, some money is going to be taken out for taxes, and what you're left with here is how much you get to bring home. So that's for the employee side. The employer. So going on to the employer side, the employer will record a payroll tax expense. Sorry, I'm kind of running out of room. We'll debit payroll tax expense. They'll pay for FICA. They're going to pay for state unemployment taxes and federal unemployment taxes. So FICA is 3825. State unemployment is 150, and federal unemployment is 400. So that adds up to 3825, 4375. So we're debiting payroll tax expense for 4,375. Credit FICA, SUTA, FUTA for these amounts. Now recognize that FICA shows up on both sides for the employer and the employee. So the employee pays towards FICA, and then the employer matches whatever the employee is paying. So that's the only one that shows up on both journal entries. That's chapter 10.